Hey, everybody, welcome back to another episode. I'm your host, Brandon Cobb, co founder of HPG Capital, and I've got a very special guest on the show today. Guys like this don't pop around too often. Neal Bawa is on the show. If you don't know Neal, he is the CEO and founder at grocapitus and Mission 10K. Those are two commercial real estate investment companies. Neal's companies use cutting edge real estate analytics and tech to source and acquire just about anything in the commercial multifamily space. He's worked with over 1,000 investors. He's raised over like $200 million of equity. I think his portfolio is pushing over $700 million in 4,400 units. We got a lot of exciting stuff to talk about today. Neal, welcome to the show. It's an honor to have you on.
Well, thanks for having me on. I think that, we've run into each other at Raise Fest and now, have a chance to be part of the podcast. So very excited to be here.
Yes, especially. So, normally we talk with a little bit of background, but I don't think you need any introduction. You've accomplished so much. I know you're well on your way to having a portfolio over $1 billion. You're one of the influencers here in the space with investing in commercial and multifamily real estate. Last year, I got to see you present at Raise Fest. You were talking about how you thought it was one of the best times to be buying multifamily. I think you thought if you looked back 10 years from now, you'd be kicking yourself for not buying more multifamily and getting in the space. That was in 2024, I believe, February of last year, somewhere around there. So
Yeah.
we're kind of coming up on a year. What's your sentiment around the multifamily space? Because this is what you're known for. It's kind of taken a beating over the last 2 years. A lot of people have sort of fled the space. They've gone to oil and gas and some other asset classes to try to get some alpha in return. What's your sentiment? Do you still think it's a good time to buy? And what do you think this year is going to look like?
I'm very bullish at this point. I think this is a tremendous time to buy multifamily. In fact, I would say I probably am more bullish than February because in February, we still had the potential upcoming recession that could, mess with our numbers. Um, And back in February 2024, we still basically were forecasting that 2024 incoming supply would hammer rents. Well, here we are in January 2025. Yes, incoming supply was massive. So we had 650,000 units deliver in 2024. We absorbed about 550,000 of them. So we didn't absorb every single unit that we delivered, but it was a massive all-time record of delivery. And our absorption rate was incredibly high at 550,000 units. Now, there were about 100,000 units that weren't absorbed. What does that really mean? Does that mean that those units didn't get rented? No, they got rented. But what happened is vacancy ticked up. So the industry vacancy, which at the beginning of the year was, a little over 94%, is now basically somewhere in the 93% or high 92. So we're at that level, but it has stabilized. So the concerns that I had in February about, rent growth issues, incoming supply, they've all been mitigated now because that did happen. We did have basically no rent growth in Southeast markets and low rent growth in other markets, right? So the Southeast markets, sort of the hyped up markets with, huge amounts of supply, the Texas markets, Nashville, Phoenix and all these kinds of markets basically had either no rent growth in 2024 or they had slightly negative rent growth, whereas other markets, especially the Northeast and the Midwest, had pretty decent net rent growth in 2024, 2 to 3%. Some places were even higher than that. So we've basically what has happened is in the last year, the following things have happened. We got past the heaviest supply. There's no doubt in my mind at this point that supply for 2025, the year that we're in, is nowhere near 2024. So we delivered 650,000 units last year. I think we're going to deliver about 350,000 this year. And our demand for multifamily should be at least 100,000 units more. This means that we should get our traditional rent growth, not super high rent growth. This is not shaping out to be some crazy year with, huge rent growth, just like 2021 was, nothing like that. But it's shaping up to be what is normal. What's normal is if inflation's 2%, rent growth 3%. If inflation's 1.5%, rent growth 2.5%. Rent growth typically tends to be about 1% higher than inflation. And so if we end up with a 2.5% inflation year, I think we should see about 3.5% rent growth. Now, there are a few markets in the Southeast that still have a lot of incoming supply this year. So you might see, depressed rent growth in some of those markets as well. Some of those markets have very high job growth, so there might still be a little bit of room for rent growth. But Austin, Dallas, there's a lot of other markets where there's just a ton of incoming supply coming in, and that supply isn't finishing in 2024. It's actually going to finish maybe in Q2 or Q3 next year, and then it's pretty much done. Now, I'm not saying that we'll have 0 units in Q4 next year, but the delivery starting Q4 for even the most bullish Southeast market should be under the demand, right? So starting Q4, every market in the United States, bar none, flips to, well, we've got less supply, more demand. That brings back pricing power. That brings back our ability to raise rents. Now,
It seems like you're
overall,
hitting that trough where everything
yep,
after rates went up, everyone finished building whatever it was they were building. They hit the screeching brakes on everything. You didn't have many starts. And so now you're about to hit that trough where all the supply from those starts are
the
getting
beginning
absorbed.
of the trough, right? So
Mhm.
here's what I want to say, that the trough that really comes in the second half of 2026. We're in the beginning of 2025. The second half of 2026 is the trough. And how can I tell you that? It takes about 2 years from the time you pull a permit to bring a building to market. Nobody's come figured out how to do it faster. So when I look at 2024 permits for multifamily, they are so low, they are so ridiculously low compared to our total demand, that I know that the second half of 2026 is going to be a high rent phase.
Yeah.
And there's really nothing that will change that unless there's a massive recession going on next year in Q4. We're going to see significantly above trend rent growth. So we 2024 was actually a shockingly good year for multifamily, but it doesn't seem that way. Why? Because rents were flat. Well, that doesn't seem like a shockingly good year because multifamily pricing actually went down on a cap rate basis. So let's say your net operating income is a million and you're getting $20 million for your property. That's called 5 cap, right? So you're getting 20 times your $1 million in net operating income. That's what people are paying for. They're paying 20 times your income, right? Well, last year, cap rates in the United States went up, which meant that the multiples went down. So if you were getting 20 times the multiples, now you might be getting 19 times the multiple, or you might be getting 18 times the multiple. So from that perspective, didn't seem like a very good year, but it was an incredible year. Because if you just back up for a moment and you look at how many units we absorb, 550,000 units were absorbed in a
Mhm.
single year. That is phenomenal. It shows, and it's bad news for the United States, good news for real estate people, that there's basically a massive amount of renter formation or renter household formation, and those people just can't buy homes. The United States has now effectively, since COVID, marooned 18 million middle class American families, people that are earning between 55K and 95K. They're marooned. They simply cannot qualify for a starter home mortgage, right? So
Mhm.
unless mortgages drop by 150 basis points, which is 1.5%, these people can't qualify. They're marooned. They're forever renters. So all of a sudden, the United States, which typically used to be, 2/3 owners, 1/3 renters, well, now we're pushing towards 40% renters, 60% owners. And that's a very big difference in a country of 337 million people. And then so all of a sudden we have this fairly affluent class of renters, 55K to 90K incomes are pretty decent incomes. And they, before COVID, these people would have been able to qualify for a single family home. But single family homes today are about 44 to 48% higher than they were one day before COVID. So in only about, COVID was, roughly 4.5 years ago. And so in 4.5 years, home prices have gone up. The average mortgage in the United States has gone up 111%. Home prices have gone up about 48%. Why did the mortgage go up so much? Well, because interest rates essentially have doubled, right?
Mhm.
So we've taken this double whammy of, well, 50% or almost 50% increase in home prices, more than 50% increase because of interest rates. And so the average, mortgage in the United States is up 111%. Incomes are only up 20%, right? So you have
Mhm.
incomes up 20%, mortgage is up 111%. Obviously, the difference between that is there's going to be more renters, and that's what we saw in 2024. So it was an incredible year for the multifamily industry, absolutely incredible. But it didn't seem like it because nobody really made that much money because rents didn't go up and prices of multifamily went down. So from a buyer's perspective, it's all truly wonderful. right? Because from a buyer's perspective, you're just getting a lower price, but you saw a demonstration of just how stunning the demand for multifamily was this year. If there was
Yeah.
one year where we say the demand for multifamily is incredible, it was 2024. And you're buying at a time when it is absolutely clear. Anyone that can read a one-page CoStar report for any market, it doesn't really matter. Here's what you're going to see in every single CoStar report, right? Either negative rent growth in the last 12 months or flat rent growth, and then an upward curve starting in Q1 or Q2 this year, going up to about 4% by the end of this year, and then slowly declining to 3% over the next 3 or 4 years, right? That's the story of every market in the United States. Now there's some ups and downs there. So markets that like Dallas, which still have a lot of inventory coming in, that upward curve is there, but it sort of stops at 2.5% rent growth instead of going up further. Markets that don't have a lot of inventory coming in at all, like Kansas City, that upward curve goes up to 6% and then falls down to 4% over the next 3 years. But the curve is the same every market. Look at 200 CoStar reports and you'll see the same curve 200 times, because in every single market, the supply is now going to end either in Q1 or Q2 or Q3 or, in some cases, Q4. That's why I'm very bullish. The second reason I'm bullish is I no longer fear a recession. So at this point, right? So 1 year ago, when people, on stage, I'm answering questions, you're listening to me at Raise Fest, and I'm saying, I don't know if there's going to be a recession or not. I think the chances of a recession are fairly low, maybe less than 50%. Today, I think the chances of a recession are in the 20% range, because if a recession was going to happen, it was going to be in the second half of 2024. The people have all these indicators and metrics. If X and Y happens, then 18 months later, you get a recession. If the yield curve, inverts, then 12 to
Inverts,
18 months
yeah.
later, you have the recession. So there's like 6 different metrics. But we passed all of those 6 at this point in time. So either this time something is delaying the recession for reasons that nobody can articulate, or we passed through the danger and came out the other side. So for the first time, so the Fed has raised interest rates 9 times since World War II. 8 times we went to a recession. The 9th time was almost a recession. So in all 9 times, the Fed killed inflation. So the Fed has a 100% track record of killing inflation and a nearly 100% track record of putting us into a recession while doing so, right? So this time may be different. And the answer for it is, why is it different this time? Well, I think it was the helicopter money. We had $1 trillion that we printed and put into the hands of the average American in 2021 and 2022, and we basically have burned through that money. It's gone. That money is gone. But because we burned through that, we didn't get to a high unemployment rate. In the past 9 cycles, right? About 2 years after the Fed starts raising, unemployment is at 5.5%, 6%, even 7%. The United States is now going backward in unemployment. The unemployment rate is now declining. So it went up to 4.3, then 4.2, then 4.1, now down to 4. So we've basically gotten to the bottom of the cycle where the Fed has, done its worst. They've raised rates lots and lots of times. And then they've gotten to the point where they're starting to even cut rates because they're afraid that the economy is weakening. It's not weakening. The unemployment rate is falling. It's not going upwards. So I think we've hit the bottom of the cycle. It may be that we, see slowing growth, so that there's a possibility of slowing growth, but I don't think we're going to see a recession anymore. So if you now Google or ask ChatGPT, give me 2025 predictions from major banks and other sources on the likelihood of recession, you'll see numbers like 10%, 20%. And then if you ask ChatGPT, 1 year ago, what were the forecasts? They were 40%, 60%, 70%. Now we're 10, 20, 25. Even the most bearish, source is probably 30% chance of a recession. So, we got through our worst year. We did it with no change in unemployment for the United States. And I think at this point, we're not going to go into a recession. So we're actually ahead of where we were in February 2024. And one last thing, the average price of multifamily today in January 2025 is about 5% lower for the same income than it was when I was on stage in February last year, about 5% lower.
Let me ask you this. You did a great job laying out the reasons for why the recession is potentially, behind us or never happened, printing the $1 trillion, and we've been through all the indicators. It seems like everybody was expecting this $2 trillion wave of commercial debt to come due, and it was multifamily doom and gloom, and everyone was waiting, and we saw back the kind of the cracks in the system with the San Francisco downtown office portfolio. We saw some cracks in the system from some Dallas and other parts of Texas were having some pretty big foreclosures. And, there were some things that happened. We saw some foreclosures trickle in, but it wasn't this big doom and gloom event that everybody thought was going to kind of cascade and unfold by the end of 2024. Why do you think that is? It really hasn't been as bad as everybody was predicting.
So let me sort of break this into pieces because it's not the same answer for all of the different parts of commercial real estate. So the two areas that people were most nervous about a year ago because of this $2 trillion wave of refinancing that was coming up were multifamily and office. Multifamily and office are the largest two portions, right? So multifamily is by far the largest part of commercial real estate, and then you've got office, and then you've got others like retail and hotel. So people were really worried about office because office is different from multifamily. With multifamily, with all this supply coming in, Brandon, we've gone from 95% occupancy to about 93% occupancy. So we've dropped occupancy by about 2% with an avalanche of, call it 1.5 million units, right? Which we weathered. So we weathered it by dropping our vacancy about, increasing our vacancy, or dropping our occupancy, increasing our vacancy by about 2%. On the office side, though, it used to be about, one day before COVID, the office vacancy nationwide was around 90%. Now it's about 80%, right? So they've dropped 10%, which is catastrophic, right? Because at 80%, you're not making any money. You're losing money and you're bleeding every single month. So the situation for multifamily and the situation for office are very, very different. So the delinquency rates for office today are in the 17% range. What that means is 17% of the mortgages for offices are delinquent by at least 30 days. And a lot of these delinquencies are fairly small, 30 days, 60 days, and they'll be cured. But 17% is still an incredibly high number. So people are nervous about it. Here's the good news. Even though 17% of office mortgages are delinquent, what's happening is that banks are not choosing not to foreclose on them, right? So when they're delinquent, they can basically go back and say, "Yay, I'm not going to give you an extension. I'm just going to foreclose." This is what has been proven by the last 12 months. Banks say, "I don't want an office property back. Just do beg, borrow, steal, get money from anywhere. Just keep paying my damn mortgage and I'll keep giving you extensions." So what we saw in 2024 was an overwhelming majority of all office mortgages were kicked down the road. Overwhelming majority. If you could somehow find a way to pay your mortgage, they kicked it down the road. If you couldn't find a way to pay your mortgage and you went back to the bank and said, "Hey, give me some kind of an adjustment or deferment where you take 20% of my mortgage payment and add it to the total at the end," they still let you do that, right? So they were not only kicking the can down the road, they were actually making active adjustments to the loan to kick the
They're
can down the
playing
road.
ball with you.
Exactly. And they're doing that across the board with the office portfolio. We really did not see a huge. Now, there were some properties that were just too far gone for the banks to basically do anything with them. And there have been foreclosures. You mentioned San Francisco. There's a couple other big markets, especially in California, where the values had eroded so much for certain assets that there was no way to do anything but to do foreclosures. But the total foreclosure numbers are in the billions. And when you have a market, the office market is, over $1 trillion. That's 1,000 billion. So when you have 1 billion or 2 billion or 3 billion in foreclosures, that doesn't actually have any impact. That's a drop in the bucket. So that's what happened on the office side. Now on the multifamily side, it was a little bit different. So a lot of the lenders are extremely confident that when it comes to multifamily, if they basically foreclose on a property, they'll be able to flip it in 60 days because there's just so much money, right, in the multifamily market. Here's an example. So in the last 9 months, we've built a bunch of properties. We've done all kinds of interesting stuff. We've put our feet on tens of millions of dollars of land because land's really cheap right now. We haven't managed to buy one value add property. So we have a quota, which is 2 offers a week, right? So our team has been consistently hitting that quota. So I would say since you saw me in February 2024 on stage, in 11 months, that's about 44 weeks, we've made about 88 offers and we've lost all 88 offers. On average, there were about 10 to 15 offers on every property that we were making an offer on, 10 to 15. So is there any kind of decrease in interest in multifamily? Absolutely not. Is there a
No.
decrease in prices? Sure. People are willing to pay less because the mortgages are higher, the interest rates are higher. They're paying less, right? But the interest level is there, right? The market wants to buy everything that appears. In fact, there's a lack of inventory, especially in markets that are distressed, because people are somehow managing to keep their property off the market by getting their bank's help. So there's actually just not a lot of inventory. So at this point, any property, decent property that comes to market gets snapped up. And there's, people offering day one hard money. So can I say that the multifamily market is distressed? No. You don't in a distressed market, people don't offer sight unseen day one $100,000 or $200,000 of hard money. What if they don't like the property? They're out that money. People don't make 10, 15, 20, 25 offers on a property. So the market is completely fluid and liquid, right? Here's the catch, and here's the opportunity. So at the beginning of this year, when I was at Raise Fest, you were watching, the delinquencies, and there's a company called CredIQ, CRED space IQ. So type in CredIQ 2025, and you'll see, their delinquencies for all sorts of different sectors, hotels, apartments, office. Those delinquencies have been ticking up. So they were at the beginning of the year, they were 5 or 6% of delinquency, which is not a big number because a lot of these are just 30-day, 60-day delinquencies. Now they're at 12%. So there's definitely an increased supply of distressed properties for multifamily that will come to market.
Mm-hmm.
But let's say all of these properties were going to come to market in 2025. I wouldn't be worried about them because the market itself is liquid. You'll just get a lower price because now instead of 10 to 15 offers, there's 3 or 4 offers. So we might see a reduction in price in the first half of 2025. I can tell you we won't see any kind of reduction in price in the second half of 2025 because most markets return to pricing power in the second half as supply wanes. Now, many markets have already returned to pricing power. Many markets are where landlords are saying, sorry, I'm going to raise your rent by 3%, 4%, 5%. That's happening in, let's call it a third of the markets in the US. And by the second half of this year, that would probably happen in 70 to say 80% of the markets in the US. And when rents go up, at that point, people are not willing to sell their property at any level of distress. So I still think that we've got 6 months of a window of opportunity. Delinquencies are ticking up. More properties will come to market in the first half of this year than in the second half of last year because people do have to bring these properties to market. If there's too much of a delinquency, the bank says, hey, I'll give you 90 days to sell it, but otherwise, I'm going to take this property back. We have not seen a lot of loan adjustments in multifamily. I can tell you what we are seeing, and I'll just give you an example of one of my properties. So I'll just give you a true example. So I have a property in Killeen. It's called Country Place Killeen, 128 units. Property is doing well. So my current lease level is about 95, 96%, right? So property is doing okay. Bank's happy with our performance. The challenge is the value of that property has fallen, like every other property, by 27, 28%. So now I'm coming up for my refinance, and the bank, I have an extension, so I can just pay for an extension for 1 year, and then I can get another extension. So I have 2 extensions that I can get. The first one triggers in February. And so I went to the bank and I said, look, I can't really sell this property. If I sell it, I'll sell it at a loss. You got to give me my extension. So the bank said, okay, I want you to buy a rate cap. And the rate cap was $237,000. And I want you to pay my extension fee, which was $91,000. So basically $327,000 hit. So we, raised some equity, some loans, prep equity on that property. We gave that money to the bank. Now we have an extension for a year. So if your property is doing well, if you're at 96, 97% occupancy, if you're not in the 70s, not in the low 80s, the banks are basically just letting you extend it, even though they didn't have to, because my property was not hitting the benchmark for me to get that extension. The benchmark is it's a technical term in the industry called DSCR, so debt service coverage ratio, and you're supposed to hit 1.25 for them to give you an extension. The property is basically at 1.05 maybe, or 1 point, maybe even at 1. but it's covering its mortgage and I'm paying my mortgage, right? So the bank's like, okay, well, we're not gonna worry about the fact that you were supposed to be at this DSCR. Just get your rate cap, pay my extension fee, and I'll let you extend. So a very significant portion of the properties that are 30-day delinquent are in that bucket where they can get a 1 year extension, they can get a 2 year extension. And that's what we're going to see. A lot of these will just basically be extended. So in that way, and only in that way, the banks are letting these things go back. Now, what if my property country plays clean? What if there was no extension, right? That then for multifamily, the banks are not willing to basically say, no, I'll give you an extension. If you're still at a 1 DSCR and you don't have an extension, they want you to sell it. Why? Because what's the worst that can happen, right? I give the property back to them, they'll flip it in 60 days, somebody else will buy it. So for multifamily, banks are, you know, if there is an extension, they're being kind to you. If there isn't an extension, they're taking properties back. For office, they're just kind to you in every case.
Just beg, borrow, and still just pay the payments on the office space. That makes sense. We just had a historic election. Trump's in. Everyone wants to know, what does Neal think his presidency is going to have? What effect is it going to have on the economy and in this particular space?
Well, I think the first thing that we can expect is, and I've been saying this for 3 or 4 months, I think, Trump's smarter than some of the Democrats give him credit for. He did the whole tariff thing. It led to him winning, getting a mandate. But I never thought that he's just going to walk in on the first day and basically put in 60% tariffs on China, because the inflation spike would be 6 weeks, 7 weeks later, and there would be chaos here. As it happened yesterday, he basically opened with no tariffs on China, none whatsoever. He isn't even willing to offer a time frame of that, but he is threatening both Canada and Mexico with a 25% tariff in February sometime. So he's basically saying, I'll give you a month, come up with a plan. Of the two, I think he's only doing Canada for some very strategic reasons. I think the chances that we actually put tariffs on Canada are close to zero. I think that the chances that we put tariffs on Mexico are very high, probably 90, 95%. May not be 25% tariffs, but I think we'll put some tariffs on there to create some pain for them. And so, I recently looked at some of the major leading economists as to what that means. And essentially, inflation would go up by 0.2% if we enforced a 25% tariff on Mexico. I think with other guys like China, he's going to take his time, because there's a lot of negotiation. There's a lot of challenges to basically just enforcing a tariff on China. So what I can say today, he went into office yesterday, and based on his executive orders, we are seeing what we thought would happen. All of the rah-rah for tariffs was to win votes. And now I think they're going to be common sense about this. So I expect that inflation will go up by somewhere around 0.3%. So if it was going to be 2% for the year, it's not going to be 2.3%. If it was going to be 3%, it's not going to be 3.3%. That's a marginal change because of tariffs. So I don't think tariffs affect the overall US economy as much this year. I'm not going to speculate on next year. We'll see what happens. I think that what we may see, and this remains to be seen, is what he does with immigration. So where I'm afraid for multifamily, where I'm afraid that he might disrupt my business, is not at all to do with tariffs. I am fearful because one of the reasons why 2024 had that incredible 550,000 unit absorption is because there was so many immigrants. And when immigrants come in, they take Class C properties or Class D, which basically fills up the Class C, which means that some of the Class C people now move up to Bs, some of the B people move up to As, and basically there's just more absorption across the board. If he manages to somehow get around all the legal challenges and kick out, call it 1 or 2 million people, the chances that he'll kick out 8 million people are extraordinarily unlikely. So let's just talk about what's likely to happen. Can he kick out 1 million people? Absolutely. I think that's possible. Would that hurt? Yeah, I think it would hurt. I think, multifamily occupancy will drop by at least 1 percentage point. So if we're at 93.5, we'll drop to 92.5%. So here's what I'll say. I think we lose 1% of rent growth for every million people that he kicks out, roughly. Those are the numbers that I've seen. So if we were going to get 3% rent growth with him kicking nobody out, we'll get 2 if he kicks out a million people. We'll get 1 if he kicks out 2 million people, and we'll get none if he kicks out 3 million people. The chances that he'll kick 3 million people out in a year are extremely
Yeah.
unlikely, but that's really it. I think that we lose a million of these people, um, we lose a percentage of rent growth, and that will hurt. That will hurt.
Yeah, I can see where you're coming up with the math on that as well. Yeah, overall, with where other promises that Trump has made on the economy, good, bad, what's your take?
The truth is, I mean, there's not that much that presidents can do. All these sorts of promises, a lot of them obviously are to get elected. He just doesn't have a huge amount of leeway. He's taken us out of, yesterday he took us out of the Paris Agreement. That's fine, doesn't change anything. He's basically says, well, I will drill, baby, drill. I don't believe that that has any short-term impact, just so you know. We were drill baby drill before, Trump took office. The United States produced more natural gas and more oil than any other country in the world, both for natural gas and oil. 2024 was the all-time record in terms of total production by the U.S. We also exported more than we've exported for the last 50 years. So the not all-time, record, but if you look at the last 50 years, we exported more. We're now basically exporting massive amounts of liquid natural gas to Europe to make up for the gas that they're not getting from Russia. So honestly, I mean, there's these things that he's doing that he wants to do in Alaska where he wants to drill. That's 2 or 3 years out. There's no pipelines there. So they start drilling, they have to figure out how to get that oil down into Canada or into the US. So we're talking about 2 years, 3 years. So the
Hmm.
drill baby drill concept, I don't think it has any meaning at all in 2025. In 2026, sure, it could bring the prices of gas down a little bit, but
Yeah.
I just don't think that the Biden administration was actively preventing the United States from producing oil. You don't get to world record numbers on both oil and gas if the impact was there. So on that one, nah, not much. Just worried about the immigration piece.
Yeah, no, it makes a lot of sense. You mentioned earlier that you were buying a lot of land, and I saw in some of the stuff that you put out, you've had this strategy about strategic land squatting. I'm in Nashville, Tennessee. We develop a lot of land. We sell it to national home builders. That's kind of like our niche. We focus on affordable entry level housing that also has had an effect affected by interest rates. Tell us a little bit more, where are the opportunities that you're seeing in land, and what are you still bullish on this strategy, and what is the strategic land squatting?
So, until the end of 2022, if you were in a bullish market, Raleigh or Dallas, these bigger bullish markets, you basically had 6 months, maybe 12 at the most, to close on land. You were paying a lot. So let's say you were building townhomes, you were paying 40 or $50,000 per pad, even for raw land that wasn't entitled, and they were giving you 6 to 12 months before you had to pay for the land. So it was a very tough situation. Today, what has happened is for raw land, we are in a depression, or I should say a recession, not a depression, but a recession. So raw land's been hit a lot harder than, let's say, multifamily or even office. So um, here's what I'm doing, right? I'll give you actual numbers. I'm going to read these off so you know what I'm saying. In the last 12 months, we have put 6,278 land parcels in our pipeline. We've underwritten 713. We've sent 116 lowball offers. 51 of them are under consideration, meaning they're talking with us. 11 are in LOI status. 8 are in PSA or purchase and sale agreement status. So that's 19 parcels of land. The average parcel of land is about, maybe 12 or 13 acres. So I've got 200 acres of land that I have in basically my control. Here's the coolest thing. All 200 acres, the contract says that I have 21 months to close. And my highest deposit is $46,000. So I'm basically putting down maybe a third of the deposit that I was 3 years ago. And instead of getting 6 or 12 months to close, I'm getting 21 months to close. And
Mm,
that's like magic because the total amount of deposit that I have out for these 18 parcels of land. I think, is it 18? Let me see. 11 plus 8, 19. So 19 parcels of land. The total deposit that I have out is only about $600,000. So for $600,000 for 21 months, I'm controlling land that's worth probably 30, $40 million. And I'm continuing to move along on that. Probably more, maybe $50 million. That's awesome. That's land squatting. It's not land buying. I'm not actually buying this land. I'm
No.
basically squatting on it. And here's what I'm doing. And those of you that are on my social will actually see this tomorrow, where what I'm doing is out of these 19 parcels, I intend to sell 10. And my goal is to sell 10 of them. And what I'm doing, I have an in-house team, the zoning, entitlements, all of that stuff to get land from raw to shovel ready, where you can just start construction. That gap, it takes me about 12, maybe 15 months for different parcels of land to get there, to get city approval to build, let's say, 200 townhomes. And so what I'm doing is I'm entitling them for apartments or townhomes, and then I'm basically selling that land. And my average profit, I have one that I just did, which is about 1.6 million profit. My average profit is between $1 million and $1.5 million, right? So what I'm doing is I'm building a pipeline to develop projects, right? That's my plan A. But half of those I'm basically flipping to other developers. And I'm also offering them my construction services. So I have a company called Elevation, in-house zoning, entitlement, lease up, all of the different owners rep services. So if you're somebody that is not a confident developer, maybe you have lots of money, but you don't really know development well enough, we basically offer those services as well. And so you can buy the land from us, and then we will take it all the way through lease up. We'll become your consultants, your project
Yeah.
managers, essentially. And so we offer those kinds of services. And so I think that's an incredible opportunity. Now, most people, when we tell them that we need 21 months to close, they don't even respond to us, or they'll just send us an F-bomb our way. And that's why the land pipeline, 6,278, basically all of the offers that we've sent, about 10-15% get accepted. The rest of these people think that we are insane. And that's okay. I'm okay with 90% of the people thinking that I'm mad, as long as 10% of the people take my offer, right? So you have to build a large enough pipeline. 6,278 pieces of land in a year is a lot of work. So it's a 5-person team, but the return, the ROI on that team is between $5 to $10 million a year.
Yeah, I love it. So $600,000 tying up $50 million worth of real estate for 21 months, which especially if you time it right, holy cow. I mean, you could have some crazy appreciation just on the raw land alone during that time period. And if you're entitling it, which is
We
basically
are.
getting all the approvals from the city to turn it from, I call it turning farmland into entry level housing communities. I mean, there's a ton of forced appreciation happens when you do that. Like when you renovate multifamily units, you increase the rent, increase the NOI, force appreciate the value of the property. When you entitle that piece of land, there's a ton of value that gets created there in that process. So very, very cool stuff. Neal, if people want to learn more about grocapitus, learn more about you, where can they go?
One of the nicest things that I'm lucky to have is I'm the only Neal Bawa on the World Wide Web. So as long as you get my first name and last name correctly, you can just go to Google. So our most popular course, which basically is the data science course of how to find the best markets in the US, it's called Location Magic. If you want to find that, type in my first name, last name, and then followed by the word Udemy, Udemy. Udemy is the largest website in the world for free online courses. We have about 13,000 people taking the course right now. That number goes up a little bit in January because of New Year's resolutions, but usually it's about 10 to 12,000 people that are taking that course. It's a free course. There's no upsell. There's no subscription. Take it, enjoy it. You'll learn an incredible amount. It has about 1,000 five-star reviews. Um, the other way to join our ecosystem, we do 8 data-filled, analysis-filled webinars on lots of different topics: single family, multifamily, industrial, self-storage, office, Airbnbs. We just did one on Airbnbs. Last year we had 14,000 people take those webinars. And to do that, simply type in my first name, last name, and then multifamily U. That's multifamily followed by the letter U. That's Multifamily University. Or just go to multifamilyu.com and you'll see all of our webinars. I think there's about 30 archived webinars there. They're different from a standard webinar. This is not a podcast. It's a 50 to 60 slide, 90-minute webinar with about, each webinar has about 100 questions from the audience. We usually have about 500 people watching. And we just give that deck away. We give the webinar away to anybody and everybody. You don't need to buy anything from us. We don't offer a subscription and we don't do education. All of our education is free. So the best way to connect with us is simply go to multifamilyu.com and join our ecosystem. Of the 84,000 people that are currently members, 1.25% are investors. So we have 1,200 investors out of 84,000 people. Everybody else is just getting free stuff, and we're fine with that.
Yeah, it's free. And guys and gals listening, the content is fantastic. So go check that out. We'll make sure it gets posted in the show notes. Neal, it's been an absolute pleasure having you on the show today.
Thanks for having me on the show.